Good morning, everybody, and welcome to this ESMA webinar on our carbon markets report for 2024. Just a couple of housekeeping points before we get started. This meeting will be recorded, so I think it's fine if you write your questions in the Q&A. Your name will not appear, and we'll pick up and read the questions at the end to try and answer them. We will try to make the slides available after the meeting, or if you have any direct requests or questions, you can also write to us at risk.analysis@esma.europa.eu. We'll take about 25-30 minutes for the presentation, and then we'll leave a bit of time for questions and answers at the end of the webinar. So with me today are Paul Heisch and Lorenzo Danieli, and the three of us will take you through the main findings of the carbon markets report. I hope you can see the slides. It should be fine, but if that's not the case, or if you have any technical issues, please do write in the chat, and this is also where we'll pick up the questions for answers at the end. So let me start with the reason for this report. So in 2022, ESMA originally wrote a first report on EU emission allowances, and there it is, markets related to these allowances. And it led us to a certain number of conclusions regarding the trading and availability of emission allowances, including a recommendation to monitor on an ongoing basis the market for emission allowances. I'm posting in the chat the link to the report, which hopefully you will be able to see. In case you're interested, it's a much longer and much more comprehensive report, not just about the trading, but also supervisory aspects. I would encourage you to have a look if you're interested in more broadly the functioning of the market itself. But so the recommendation from that report led to the European Commission including a mandate in the EU ETS directive, which followed the Fit for 55 package, which some of you may, I'm sure, be familiar with, and led to a number of revisions in the EU ETS, including much more significant ones, obviously, than this one. But for us, it meant monitoring the market on an ongoing basis along the four main lines that are outlined in the slides here. The organization of the report follows that general approach, so it's structured along the same lines. So we'll take a look first at market volatility and price evolution in emission allowance markets, then auctions markets, followed by trading in secondary markets, including derivatives and spot markets, and finally trading behavior and positions of market participants. Last little bit I wanted to mention before we actually get into the contents is that this will be an annual report. So ESMA has a mandate to produce once a year a report that informs the European Commission's decision when it comes to the EU ETS. So you will see again this report in the future, and the interest, of course, for both market observers generally, but also the European Commission, is that the report leverages on regulatory data which we've obtained through various means. Now, let me just say a word by way of introduction about the general functioning of the EU ETS market. I realize a number of you may already be familiar with this, but this is not necessarily the case, and it's quite a peculiar market compared with more traditional either equity or commodity markets. It is very much centered or organized around the annual compliance cycle that exists in the EU ETS, whereby every year a certain number of new allocations are added or put on the markets, either through free allocation, which are granted by member states to companies within sectors that are at risk of carbon leakage, or through regular auctions that are held at the European Energy Exchange on a regular basis throughout the year. So that brings additional supply to the market on an ongoing basis. Throughout the year, there is trading of EU emission allowances going on. This is done mainly through derivatives. There's also a bit of spot trading, and Lorenzo will take you through that. And then once a year, emission allowances are then surrendered to the legislator on the basis of verified greenhouse gas emissions, scope 1, so direct emissions, So the number of allowances the number of allowances surrendered needs to correspond to the amount of greenhouse gas emissions, and at the same time, the amount of allowances available in the markets structurally decreases over time. Now that gives you a sort of overview of the general organization of the markets, and then I will turn over to Paul, who will take you through the first two bits of the presentation. Thank you.
Okay, so first, this is kind of also structured along the chapters of the report. I will quickly take you through a general overview of the price developments over the last year, so basically over 2023. On the right-hand side of this slide, you see this price development over the last 2 years. And if you look for January 2023, you see that the price was around 100 euro per emission allowance, which is equivalent to 1 ton of CO2. And this kind of declined over the year to 80 euros in December 2023. But then in 2024, there was even like a further decline, almost down to 50 euro per emission allowance. In our report, we have identified 3 main price drivers which caused this decline of prices. First, we found that there was a general economic downturn in 2023, or let's say like a slower economic growth, leading to lower economic output, lower energy demand, and therewith also lower demand for emission allowances to produce energy or any other goods. Second, we found that there was a wide, let's call it decarbonization in the power generation sector, which was first driven by an increased fuel switching. So the gas price declined in 2023, which led to energy producer favoring gas compared to coal, and gas is the lower emitting energy source. And so this kind of affected the demand for emission allowances. And on the other hand, we also saw kind of a greening of the power generation, so an increased switch to renewable energies, which in turn also affected the demand for emission allowances. And third, we found that also on the supply side, there was a slight uptick in emission allowance supply, which was mainly caused by the Repower EU program, which led to kind of a front loading of emission allowances. And this kind of situation is also shown on the left-hand side of this slide, which shows you the demand on the bottom of the chart in blue, and then the supply on the top of the chart. And what we've seen from 2021 to 2022 and 2023 is this kind of decline in the demand for emission allowances. So this is surrendered allowances, so emissions in the economy. And then on the top, you see kind of this decline of the supply from 21 to 22, but more or less stable, or in fact, actually slightly higher supply in 2023. And those kind of factors together, they affected the price just mechanically. Moving on now to the futures market, which is kind of the main instrument how emission allowances are traded. So spot trading is really only a fraction of the market. The main trading activity is happening in futures. We've just looked kind of descriptively at the futures curve. So kind of the different maturities of futures from 1 year to 5 years. And what you're seeing on the left-hand chart is that this futures curve first kind of moved in line with the spot prices. So in 2022, we saw kind of the spot price around, so this is July, spot price around, I don't know, 75, then moving up to July 2023 to 90, and then moving down until July 2024. So this curve is kind of shifting with the price. And what we also found is kind of a flattening of the curve, which is also depicted on in the right-hand side chart, which is basically the cost of carry, so the difference in price between the 1 year and the 5-year maturity. And we saw this kind of cost of carry decreasing over most of 2023. And this was mainly driven by, let's say, kind of interest rates, like the lower discount rate, which is the main driver of the cost of carry for emission allowances in the absence of any storage costs. Moving now to the primary market. So this is the second chapter of our report, which is targeting kind of the supply through auctions at the European Energy Exchange. We saw on the left-hand side the monthly auctioning volume just is kind of is following a usual cycle. So what you can see is that there are some slumps in August and December, which is due to holiday seasons, and then the monthly supply of auctioned allowances is fluctuating slightly over the different months. What we also saw is that the majority of auctioned allowances were in fact European emission allowances, and only a minority of allowances were aviation allowances, which is shown in green. So I think it's really below 1% of the overall allowances were aviation allowances. Overall, those volumes, so this is a number of allowances, was slightly higher, as already mentioned, due to kind of this front loading to finance the REPowerEU package, which, however, means that while those allowances are auctioned now, they won't be auctioned later on, and there might be a further tightening from 2026 onwards. What you can see on the right-hand side chart is a breakdown of the entities, so the legal entities which are purchasing emission allowances in the primary market. We see that the majority of allowances are purchased by investment firms and other non-financials, and kind of only a minority directly by entities which are under compliance obligations. So firms which are directly obliged to surrender emission allowances for their emissions. However, please be aware that, for example, a big part of those green areas still may be part of a larger corporate group with compliance obligations. For example, we've seen a lot of energy firms. They have dedicated trading arms, which are separate legal entities without compliance obligations, but still they are purchasing the emission allowances for, of course, the compliance part of the group. Moving on to the next slide, just a tiny overview of kind of the, let's call it, microstructure of the auctions, where on the left-hand side you see the number of auction participants and kind of the coverage of the bids. So the blue line is depicting how many auction participants on average were participating in one auction, and we found that it was around 20 bidders per auction, and out of those 20 bidders, 5 bidders on average did not get some volume allocated, which of course is also driven by the value of the bid. So if you're bidding in an auction, if you're bidding a higher price, you're more likely to get some volume. But if you're bidding a lower price, then it might of course happen that you're not part of the cleared volume. But overall, we see that 3/4 of the bidders, they obtained the allowances, and we didn't find any major concern. Overall, we found that all those auctions were oversubscribed in 2023, so there was also not any issue with that. On the right-hand side of the slide, another major observation, which is kind of that the auctioning volume is more or less concentrated among a few auction participants. We found that 10 entities alone purchased around 90% of the auction allowances. And as you can also see by the color coding, is that those 10 entities, they are part of different sectors. So they are investment firms who are partly doing it on behalf of other clients. There are some non-financials which may do it for their group. And then there are also some compliance entities themselves. So we found kind of this larger concentration there in terms of auctioned allowances. However, what we've also seen in a previous report is that in fact, the dissemination from those entities to the wider market seemed, at least in the past, to work without major friction. And that's it to the primary market, and Lorenzo will take over for the trading.
Yes, thank you. Thank you very much, Paul. So now we move into the secondary market part of the carbon markets world. So here we will, in the next 3 slides, we will show statistics related to the transactions that involved the exchange of European carbon emission allowances that occurred on European trading venues. So first of all, let's start with the main actors in the markets. Overall, most transactions in EUA were executed by investment firms and banks, as it is also possible to observe in the chart. But what this Sankey shows is also that most of the trading volumes that were executed in 2023 occurred on exchange. As you can see, the green lines show the on exchange trading, while trading over the counter accounts for a limited share of the total. All the trading was mainly concentrated into a single trading venue, which is ICE, while these volumes account for 90% of total volumes, while the rest were executed mainly on EX. In terms of other players, we can also see that investment funds played somehow some role, mainly of exchange in the trading of EUA derivatives, but this still accounts to around 10% of total trading. So in the next 2 slides, I will focus mainly on exchange and off exchange trading, particularly. So if we go to the next slide, in which we focus on the on exchange trading. First of all, the total volumes bought in EUAs accounted for 648 billion euros, and just to give you an equivalent in tons of CO2 equivalent emissions, these were about 9.3 billion tons of CO2 equivalent emissions. In terms of instruments, mostly on venue trading occurred through future derivative contracts or mini futures, which represented about 99% of the transactions and 81% of the total trading volumes. In terms of other instruments, though there were only few transactions in option contract, they were exchanged in a larger size, and the trading volumes in option contracts were about 18% of total trading volumes in 2023. So if we take a look at the top left chart, in which we show the evolution of daily number of transactions in EUA derivative, we see that overall the trend look quite stable without any major movement. However, they show 3 main peaks of activity. The first one was in June, and this possibly relates to increased activity linked to the news of the publication of the Green Finance Package by the European Commission. And then it is possible to observe also 2 peaks, one in March and another one in December. And this is when mainly the most liquid future contracts expire. And the intuition behind this is that entities with large compliance obligation often buy derivatives to lock in EUA prices and limit balance sheet exposures. And mainly this strategy helps them to control cash flow throughout the year. Normally, what happens in the market is that compliance entities typically purchase December futures, and after buying, they have two main options. The first one is to hold it until expiry and then take the delivery of the physical underlying. Or alternatively, they can roll over their positions to March, which normally coincides with the annual publication of the verified GHG emissions by compliance entities, or to the following December contract. Another interesting dynamic that we observed from the data is that about 40% of the total volumes traded on exchange originated from so-called trades on spreads. And basically, these transactions are normally transactions that combine simultaneous purchase and sale of more than one financial instruments, and these traded are executed contingent on each other, and they're normally packaged together with the objective to create a non-directional exposure to EUA maturity spreads. If we take a look at the top right chart, which also shows the picture that we saw before, but in terms of monthly volumes, we see that in terms of magnitude, investment firms or credit institutions account for 65% of total trading volumes, followed by other non-financials. Finally, if we take a look at the off-exchange compass in the next slide, we observe that, as mentioned before, OTC trading only accounted for a small share of total trading volumes in EUAs. Overall, there were about 524,000 OTC transactions that accounted for 864 million tons of CO2 equivalent. In monetary amounts, these were around 72.5 billion. Overall, this represents less than 1/10 of total volumes that were executed on exchange. Something interesting that we observe in the OTC space is this positive correlation between the number of on-exchange and off-exchange transactions per day, which points towards a moderate movement of market activity in the two market segments. So also here we see a moderate increase in trading in December, and both on and off exchange trading in December may also reflect the coincide with the drop in prices that Paul explained before. But what drove mainly the OTC volumes in December, the increase in OTC volumes in December, is the trading in spot contracts, which was much larger than on average each and every other month during the year. Having said that, I will pass the ball back to Julien for the last part of the presentation.
Thank you, Lorenzo. So I will now speak about derivatives market positions. So just to explain a little bit what we mean with derivatives positions, this is a different type of data compared to what Lorenzo was describing, which is transaction by transaction analysis. Instead, here we've obtained reports on open derivatives positions that are held by market participants at the different trading venues in Europe. So this tells us a little bit about the overall positioning of the different sectors throughout the year, in between the moment that a contract is open and the settlement of that contract towards the end. This is quite useful for us to help understand a little bit the different behavior of market participants, and there are different interesting observations we can make. The first one being that the largest number of emission allowance derivatives market participants is actually the investment fund sector. So we have, on average, somewhere between 750 and 800 participants, derivatives market participants, and that includes around 400 investment funds on average every day. So that means around half of the participants holding open positions in emission allowance derivatives markets are investment funds. This is much larger than the other sectors, as you can see from the chart on the left. Now, that does not mean they're necessarily extremely influential or impactful on the market, because if you look then at the number of positions that are open, which corresponds then to the total notional amounts outstanding of emission allowances that are traded through these derivatives, investment funds actually account for a relatively limited share of the total number of gross positions, so about 5-6% throughout the year. In reality, most of the positions are held by investment firms and banks, so that's the green line that you can see, or the green column on the right-hand side. Followed by a non-financial sector, which covers both compliance entities and other non-financial sector corporations. As Paul described earlier, this is also a feature of the reporting and the sort of analysis of the data, whereby some of the firms that are actually within compliance groups may be separate legal entities, and therefore they're trading on their behalf, and these are captured under other non-financials, but they may still be participating in the market for compliance reasons. Now, the importance, or the relative importance of the financial intermediaries and the non-financial sector in the overall number of positions that are open is reflected in also the net positioning. So this slide describes basically the net position of each sector. So we're taking the difference between the number of long and short position in emission allowance derivatives. And as you can see on the left-hand side, non-financial sector corporations, so compliance entities and others, are generally long in the market. So they buy allowances through mainly futures, whereas investment firms and credit institutions or banks are mainly short in the market. So they take the opposite sides of compliance entities or non-financial sector entities, and therefore deliver throughout the year, especially around the expiry of the most liquid contracts, the allowances that compliance entities need to source in order to surrender emissions, as I described at the beginning. So this sort of quite unique organization is, as I was explaining earlier, very reflective of the organization of the market and the annual compliance cycle. And as you can see, still on the left-hand side chart, you have some drops in the number of positions that are open, both on the net long and net short side. And that corresponds to the surrender dates of emission allowances, where basically the number of allowances sort of leave the markets, and with a view to achieve this, you have basically a reduction in the number of open positions with contracts being settled and the delivery of allowances for compliance entities executed. Now, one final observation is these observations do not quite hold for investment funds. As you can see on the right-hand side, which sort of zooms into the net position of funds, the positions that investment funds hold tend to move quite a bit. It's actually relatively highly correlated with emission allowance prices. So investment funds take a much more directional view of the market compared with other sectors that are participating in derivatives. And the fact that their positioning has turned gradually short in the course of 2023 reflects the generally bearish outlook that they held that year when it comes to future emission allowance price developments. So this concludes our presentation. We have a few bits summarized here on this slides. I think we're already past 10:30, so in the interest of time, I won't take you through these general details. I just wanted to highlight that, again, this is the first of a series of annual report that we will have to produce on the functioning of the EU ETS, and especially trading and auctioning in EU ETS. So you will see other editions of this report in the future. Now, we're interested in, of course, any questions you might have, any need for clarifications, but also if you have suggestions as to interesting bits or analysis that you think ESMA should undertake in order to explore some aspects of the markets of the trading based on regulatory data that we have access to, would be, of course, very interesting too. This concludes our presentation, and we're happy to take questions if there are any. So I'll wait a couple of minutes to see if anything appears in the chat. Thank you. Okay, it is 10:45 now, and I think we've run out of questions. Thank you, everybody, for joining this webinar, and thank you for your questions. If you have any other questions or you would like any other information in the future, please feel free to reach out to us directly or to our generic email address. We have you can write to us at risk.analysis@esma.europa.eu. And otherwise, I would invite you to have a look at the report, which is available on our website, and to keep an eye on future editions of the reports. And with this, we'll close the webinar, and thank you all for your attendance and participation. Have a good day.